Good morning, traders. Welcome to the next most important day in our lives in the FX markets. Let me just kill my squawk for a bit. So we have a bit of a big day ahead of us with the ECB and the US third quarter GDP coming out in between the ECB statement and Mrs. Lagarde press conference. So it's going to be an interesting day again today. Let's first run through what's happened overnight and the main headlines. I'm going to try to keep this one a bit short so we can quickly move over to what is going to be of interest to us, of course, a bit later on today. First of all, China, as we usually do. G going to the PBOC was apparently not innocent at all. So now there's talks that he is taking the next step in controlling all the finances and markets in China with the creation of the CCP Central Financial Commission. They will be the watchdog, the planner, and the decision maker for what's going on with Chinese money. So that somewhere means that perhaps the importance of the PBOC and the Chinese SEC organization will be taking a step back, and she and his bots will take over everything that goes on there with that has to do with money. It's had a lukewarm reception in the markets. The Chinese markets did not were not really impressed with it. But again, as we've been saying for a while now, those things will need time to show what they really mean. But it says two things basically. They want to take over all the reins and see what's going on with money, so they can restrain outflows if they want, and on the other hand, they probably will want to lure in investors again into China. So interesting times ahead, I would say. Over to Japan. So since the dollar yen went over 150, of course, the finance minister Suzuki was asked again about the level of the yen, about interventions. He just repeated that the approach hasn't changed. They're still watching effects with a sense of urgency. The Deputy Chief Cabinet Minister Morai came out as well, saying that it's important for FX to move stably and in line with the fundamentals. And even Kishida was again out, as we've already heard, but he was adding a few lines to what he sees in relationship to the Bank of Japan. And he said that the Bank of Japan policy right now and the intervention, MOF intervention policy, is not contradicting with what the government is doing. I think we all are a little bit reluctant to believe what he's saying, to say the least. It has everything to do with what's going on in markets, and likely also what the Bank of Japan is doing with their monetary policy. Because I remind you that at the start of his tenure as a Bank of Japan governor, Ueda and the government both declared that they were going to work in close cooperation. So what Kishida says goes a little bit against all of that. Then there was this interesting poll out by Reuters saying that 63% versus 52 or so percent prior of the Bank of Japan analysts now predict a move away from negative rates in 2024. So that means that we are still, at least, if you take it as a fiscal year in Japan, at least 5-6 months away from a possible move. And also what it means is that there's still 30% of them thinking that they won't change anything. We have been talking already about that quite often. We think there is normalization on the way. We just don't know how fast it will go. For the time being, we have seen that it's rather a very slow process. So we had that little move this morning again when dollar yen was trading close to 153 quarters, and there were some questions asked about this move back down to below 150. I don't think it has anything to do with possible interventions or even the Bank of Japan checking markets. It's at the same time, there was a Bank of America article out that they think that the Bank of Japan is going to widen tweak the YCC next Tuesday and widen this band and allow yields to go up to 1.5%. And I think that was just an excuse for some smart cookies to get some stops out of the way under 150. I hope none of our listeners, viewers have been spooked by this move, but I don't think it has anything to do with interventions. It is a fact, though, that in theory the dollar yen should slow down. Any dollar moves, I reckon, other currencies may move faster because there is this fear of interventions that will overhang any moves in the dollar yen. If you take, for instance, that yesterday we were trading just below 150. If we go back to what Kuroda said in the days end of last year, that 200 to 300 pips moves are too rapid and are excessive. If you add those 200 points, for instance, to where we were trading yesterday, and we would have like very strong numbers in the US out this afternoon, and we would, for instance, move from today to tomorrow or so back up to those prior intervention levels close to 152, then I think we're going to have to be extremely careful going into the Friday afternoon, into the weekend. We also have to be careful, of course, after the US data this afternoon. If they disappoint, then there's not going to be this question of interventions or not. And if you look at the yen crosses, that's already what is filtering through. Most of the yen crosses are relatively on the defensive, as we have seen of late. That for Japan. Closer, then, yeah, the last thing about more like the Asian side of things, RBA's Bullock was out last night as well, saying that the inflation will likely stay a bit longer above their targets or above what they actually had expected. But she also added that the numbers that came out lately, the last numbers that came out, were kind of as they expected. So that gave the Aussie dollar a little bit of a knock. We tried to break sub those prior lows. I'm going to show that a little later. It did rebound today. I think it has more to do with the double factor of people managing their positions. Looked a little bit like a fake break below those prior lows, managing their positions ahead of the US data. And also, if you look at what's happening in the euro crosses this morning, apart from a couple of them, the euro Aussie, for instance, is a bit lower. Some of the euro crosses are giving back a bit what they gained over the past sessions. And I think that's a pre-ECB managing of the books over there. Closer to home, so we have to continue to monitor the situation, right, in the Middle East. So apparently Israel has targeted actions against Hamas. And Netanyahu also declared that there is the ground offensive to start, but they will not pre-announce it, and they will have it's going to need the unanimous decision of all those involved in the War Office and the Defense Office, etc. But it seems that targeted operations have already started, so we're going to have to be a bit careful with what's going on in risk on in the next days again. What else have I noted? Yeah, the last real thing is that the U.S. House finally has a new speaker. His name is Mike Johnson. Not a lot of people knew about him before, but apart from that, he was one of the 100 kind of lawyers, and he was one of the leaders of them trying to overturn the election results that saw Biden became president. So he is one of Trump's allies. I can only imagine what's going to happen again now with whatever the Democrats are going to want to push through. There seems to be an agreement on support to Israel, but he was also against more Ukrainian aid. So there's going to be a bit of discussions and negotiations going there forward, I trust. And that's about it for what I have on the headline front right now. Unless I missed something, you can always tell me if I missed something. So let's go and have a little bit of an overview of what's happened yesterday on the data front. Yeah, a lot to do about the mortgage thing, highest in what, 25, 30 years or so, but it didn't really move the crowds. What did move the dollar slightly was this pretty steep uptick in the new home sales. And that sparked the, I think it's the Atlanta Fed or so, to review their Q3 GDP expectations even higher than what we are already expecting, and I'll come to that a bit later. For the rest, we saw the Bank of Canada. Okay, the Bank of Canada. Then I recall yesterday I showed you the expected what the option market was expected, and that straddle, which was worth about 50-55 points. If you look at yesterday's range in dollar Canada, and you look at what the option market priced, I'm not going to say anything more, but they were right again. To me, he covered most of the bases. He does leave the door open to more rate hikes, but on the other hand, as well, him and they acknowledge that there is a slowdown in growth. We saw the revisions there. So to me, it's a relatively neutral report, neutral meeting. I was thinking that the revision of the lower growth would push the dollar CAD a little bit higher, but we're still trading the range. We still haven't gone to test that 138.5, that prior high. It's going to be the US data probably, which will decide, but the Canadian dollar could at the same time trade a bit with the oils again and the geopolitics again. So I'm for as long as this holds 137.5, 137.40, and 138.5 on the top side in dollar Canada, I'm not really going to be extremely interested in what's going on in that currency, because it can do top and bottom of the range pretty easily without breaking too much new ground. Okay, the oils, well, yeah, we had a bit of a bigger build, and that was surprising compared to the draw that we saw the day prior from the API. So they finally diverged a little bit. It did push oil a little bit lower until we had some geopolitical headlines again, some misplaced and misunderstood headlines out of Russia, some uncertainty in the Middle East again, and that was enough to push oils a bit higher. Remember, we spoke about the oils on face, and I thought that 81.5, 83 zone would have been at least a zone where we could stabilize a little bit, and that seems to be the case in the market as well. So it's going to be an interesting watch if we make it back down there. Right. Moving on, we've covered that. What's happened? Yeah, corporate service price index in Japan. That's around where the CPI is supposed to be, where they want it to be. So I'm not going to comment much on that. Foreign bonds, not too big of a move. Yeah, a bit of Swedish data out today as well. I've not been really involved in that. The Spanish unemployment data is ticking up slightly again, worrying. I don't know, but if it's a harbinger of the global unemployment state in Europe, then it could become something we have to look at. All right. So, and that's about it for what the data are right now. What's next? Well, next, it's pretty simple. We've got two things that's going to be market movers, or supposedly be market movers. ECB. Right. My base case is that they don't move anything. They may say something. Well, Lagarde will probably err on the side of our fight against inflation is not done yet. But as per prior comments, she probably will also highlight the risks in the economy, slow growth, and what not else. The kicker here during the meeting may be that they advance at least the talks, not perhaps the decisions about what's going on with all those liquidity injections, the APP, the PAPP. We've already heard from the Greek central bank governor. The meeting today, by the way, is held in Greece. So he was a bit vocal that he would not be in favor of changing anything to the PAPP right now. But we know that the hawks in the ECB have already said that they needed to look at it closer. So that is some chance, together with perhaps to do something with the tiering and stuff, where we could see a wobble or two in the euro crosses mainly. So that's something we need to keep an eye on. But base case is that it's going to be bit of a more neutral meeting than it's than the hawkish ones before. That's where the base case sort of lies. But we need to monitor the fine lines and the wording in the statement, and especially what Lagarde is going to say, of course. As we are now, the dollar is doing the heavy lifting for what we are seeing in the euro dollar. And again, and I'll show that again, the option market is not overly ecstatic about what's to happen over the euro dollar. Even the combination of both is not really moving the crowds too much in the options market. So then moving on to the other big block here, we have a lot of data coming out of the US. GDP is what I'm going to look, and then just look for some possible kickers, pushers, counterbalancing numbers out of the durable goods, perhaps. The jobless claims, we have seen that they are pretty smooth. Of course, if they start to ramp up again, that's going to counterbalance a strong GDP. So we are expecting above 4%. That thing was about 2.5% when we started to talk about what's possibly what would possibly happen on the GDP front in Q3. That has constantly been revised higher, and now we are expecting numbers above 4%. Now, take it on the face value. If they print as expected, and you're looking at a European, for instance, growth number, or UK, for instance, growth number of somewhere between 0 or even a small recession or 0.5%, if we get a number like this, I don't think it's going to stop the dollar in any way, and possibly we are going to tackle the 5% again in stuff like the 10 years, for instance. So that is my base idea here. One thing that could counterbalance a bit is if the prices come off, because we did see in Q3 some up and downs in energy prices, for instance. But then yesterday we had that better housing number. So yeah, my base case is it's going to come out not too far from where we are. Let's say 4% and above is likely going to be viewed as a very decent number, and I don't think it's going to change much to the global dollar picture. That is, it remains big. That is my view, of course. Now, due to those constant revisions, there is, of course, a real possibility that it disappoints. and therefore is probably going to have the same effect then that we have seen last Friday into Monday, and a global reassessment of, at least in the short term, of what the market was expecting. And that in turn could see yields come off again, equity markets shoot, and the dollar get a slap around the ears. So we do have a fair bit of binary risk here, although the latest data and expectations and the nowcasts support a strong number. Okay, so in that case, I think don't change a winning team, and the dollar is likely going to continue. Now, what it may do for equity markets, recall what we said when we had the jobs report, and I said it's not because we have a good report and the yields would move a bit higher on the back of it that is necessarily bad for the equity markets. We are, though, at levels where this play could perhaps not be completely valid now, because we have already seen weakness in the equity market. So it could be a bit of a complicated read for the equity markets. That is my view. I'm not really tempted to really get involved too much at current levels. But if we get a really high GDP, a really good growth is normally not too bad for equity markets either, for all US assets, right? So I would be reluctant to sell equities in a whole if they react on an initial higher yields move. Okay, the opposite will be true. I think if the yields come off a little bit on a report which is, let's say, 3.8, 3.9, which is going to be below the magic bar of 4% now, then I think the equity markets are in for a bit of a reversal and a move back above 4,200, for instance, in the S&P. Right. Let's if CPI spoke the market. Okay, Jamie, I'll come back to that, because I mean we had the CPI now. It's still a while before we have the next CPI. Okay, let's move over to the markets, right? Yeah, the PCE is tomorrow. Okay, I just wanted to highlight this, and again, for the people in our chat room, you have this under the on the web page under the market info tab. So you can go and check this for yourself. The market expectation in the options market is for, let's call it 50 pips. We know that we usually pay a bit of a spread, so a little bit over 50 pips. The overnight straddle at the money, this one in blue. That means that the option market is not expecting too much more than a 50 pips either way move for the euro dollar, but it of course can go higher. But what it certainly means is that people who would buy that, let's for instance say that you buy this overnight straddle, they call it, so you buy a put and you buy a call at the same price, same maturity. That means that you need 50 points either side to make back your premium. That means de facto that 50 points outside of where we are now, you are going to see interest on the other side, because if you're, let's say, if the euro dollar goes down to 105.5, you are going to make your premium back, and so you are starting to hedge your options, right? So that means that somewhere around 105 we should see bids in the euro dollar, and somewhere around 106 and above we should see offers in the euro dollar, for as long as the data do not go massively away from expectations. And again, this is not exact science. The market can move a lot more, but just to let you know that the options market is not overly ecstatic about what is to happen this afternoon. And we do get a combination ECB US GDP, which should normally be a big market mover. Just this for your info. Right, let's see. And as usual, the differentials, they're not moving that much. They stay on the lower end as we have seen already, but still the euro yields are moving in tandem with the dollar yields right now. So that means that your euro dollar is the slower mover if you look at all instruments. Even compared to yen overnight, the euro dollar is still the slower mover. I would expect this to move a little bit this afternoon, and that is probably going to direct the debates in euro dollar partially, right? So then we go over to what's happening in the sterling sphere, because I've done something wrong again. Yeah, I know. Okay, look at what's happening in the sterling. Look at what's happening in cable, and look at what's happening, for instance, in stuff like sterling yen, euro sterling, a few other sterling pairs. Those differentials are continue to widen a bit. Okay, we are trading at those lows. So if you get a strong GDP out of the US, I expect this to continue to widen and perhaps go closer to this 50 BPs widening, which in turn should weigh again on the sterling. Of course, it's a US data point, so this is going to be impacted. If you start to move back above 25 BPs here, or that means tighter than minus 25 BPs, we could have a move to the other side on the cable again. But for the time being, this thing is keeping the cable under the cush, and for as long as that doesn't change, the setbacks higher in cable should find sellers. Okay, again, it's not an exact science. It's not the only thing that moves market. Okay, but if you overlay it with those currency pairs, we're really not far away from reality. You can hardly brand. You can hardly pinpoint a level in cable to or in euro dollar to what those differentials are saying. It's a guide. It's just a guide. It's the same as if we always talk about the US 10s at 5%, which is a bit psychological. If it goes above, there could be more pain in the equity markets. It's just a guide. The way it moves, you overlay it though with the cable, you will see that there's a lot of similarities. Okay, so it's just something you keep an eye on. The other one to keep an eye on for this afternoon is the 10-year notes. This is your Monday and Tuesday move back up on what's his name? Ackman's declaration on Twitter saying that he moved out of his short bond positions, and we've already completely undone the whole lot. People in our room, Mark, thanks for that as well, was looking at this 106.04 zone. If it goes back below, that means that it could go all the way back down. That's exactly what it did. For the time being, we are mooching around here a little bit, a bit of managing of the books. The overall picture is still looking very negative. That means still bid for rates, in other words. And look, we are very close to earlier this month lows. Those coincide with your 5% in the 10s, really. If it would start to go, if it would go much lower, I think there's a possibility. That means on a stronger GDP. Imagine that they overshoot those GDP data, then I think it's going to be quite quickly down to those 104.20s here. So if you take this width here, 106.20 down to 105.20, it looks like that's about 15 or so, 15, 16 pp's equivalent in the yields. There is it's always the fractions, right? So you can calculate it, but I mean I was just reading your the chat as well. I see you guys having a bit of fun. Yeah, so that's a method of calculation, of course, and it's futures. So there's a bit of an additional complication in there, right? What is happening? Well, it's pretty clear what's happening. Gold is, well, I mean, geopoliticals don't like it. Gold it came back straight away from this support I showed the other day. It's geopolitics. But then again, if you look at the way it bounces, and okay, there has been some developments, but not that much new. If you look at, for instance, a currency like the Swiss, which has been trading geopolitics as well, it hasn't moved that much, the Euro Swiss, for instance. There may be something else going on here as well. And conspiracy theory popping up saying that it's perhaps again China also who likes to buy gold on dips, you know. It may have to do with it. Anyway, let's look at it for the afternoon. If we get a disappointment, yields coming back down, perhaps this is going to shoot this time. Look at what's happening in 2005. That's where the 23.6 is, and there, if it goes above, we could see a further rally up. If in turn we're getting a big number in the US, I do think that for the short term, at least, this could put in a bit of a cap and perhaps retest this level before reassessing. Okay, I'm not going to counter trade much in this right now, but I'm going to be very interested. Let's say, for instance, that the US GDP overshoots, and yet oil comes back down into this 55-65 zone and goes back up. That means that not a lot of what's happening anywhere else is going to put this lower. So that is going to tell me just what's going on in gold. Okay, that's one thing. Through a quick look, but you know, this was the zone where we talked about yesterday also, or phase where I thought, okay, we may stabilize a little bit here because it's also been a bit of a traffic zone in the past, and that's what we did. Then we had this jump on headlines again, and we're trading around this level here now, around 84 and a half, 80, 85. I don't know if it's going, if this afternoon on numbers, ECB for sure, I think it's not going to have an impact, but I don't know if the US GDP is really going to have a big impact. I'm just going to be a follower of fashion here. Just note that those two tryouts at 90 always saw very, very big rejections. So if there would be anything spastic happening in gold, in oil this afternoon, keep a very, very close eye on what's going on around there, if ever we get back up there. Currencies. Yeehaw. Right. First of all, let's go for the tight and close look. We're back below this trend line in the euro dollar. That's actually a bit closer. That's about where we are now. So that's a bit too close. Your first level should really be 105.70, as I said in the room, and on the downside 105.20. That's your very tight range. On top, again, just above 106, that is going to be the first, let's say, the minor make or break level, and that coincides with what I showed you earlier on the options expectation. So if we go back if we go to 106 on a bit of a disappointment in the US data, start to watch what's happening there. If we slow down and start to take the other way, that means that the option players are really trying to keep a grip on the markets. But it means the opposite is true. Once we are going to get lower here, keep an eye on what's going on around 105 figure 20, because the same folks will probably sit around there. So it is possible that we are going to be trading this range up and down, a bit like we've seen yesterday on in the dollar Canada, right after the Bank of Canada, remember? If we start to break, then I'm going to look at 106.35.40 again, and then or 35.50, 35.40 really, and then 107. If we break on the downside, then we are going to have to be careful. 104.80, 104.45.50, and then I need to go a bit wider. If that really would happen, here, okay, there's some support around 103 and a half, but then if we really start to break below those levels here, then I think something that means that would mean something. That means that there's a combination of a more dovish ECB a more dovish Lagarde, and an overshoot in those US data. And if you really get an overshoot in the US data, the dollar wrecking ball could really take this market by the cojones and start to really trade this lower again. Okay, I'm not saying it's going to happen today. I'm not even, my base case is not that it's going to happen today. I think if we ever get close to 104.5, 104.80, it may be enough for the euro dollar right now, but we have to be prepared for every eventuality in the markets. Okay, right. Cable is hanging around, well, hanging around and relatively close to support. Okay, we have broken back below 121.10, which was the support zone here. That is going to be your first resistance here already. 121.10, a bit close for comfort. Then 121.30, 35. I think more importantly here, if we get a revisit of this 121.70, 80 for where we started this move lower. Okay. The dollar is your driver today. There's not much coming out of the UK, although I just seen, and they always do it in the middle of the flow show. Where's your respect? So the CBI distributive trade survey for October in the UK has come out very, very negative, -36, where it was -14 expected. But I thought we had that already the other day. Anyway, that's going to be your bigger zone on the cable, in my opinion. Here, what's happening here? I'm very small in position right now. I've reduced my risk, as I said over in our chat rooms. I reduced my risk going into the data because we can always take the positions back later on. On the other side, if we start to break below this prior low here, and you confirm below here 120.10, then there is going to be little to hold cable back from a bigger move lower, a bit in line with the euro dollar. And then what I showed you already on those differentials, it's not looking overly good for the sterling. It's got to take bad numbers, I think, out of the US for the sterling to really start to turn around, right? Right now. Okay. All right, Constantine, I see your question. I'm not, unfortunately, trading nat gas, and I'm not really planning to look at it right now. Sorry about that. Maybe that's a question for FaZe, because I know the people over there. Dale for sure is looking at nat gas. Maybe you can ask the question there. Right, over to Ali. You see, Ali, I never forget you, right? What is it you said? You're long Dorian. As a long-term trade at 47. Yeah, but so okay, there's a few things I want to say about your trade to start. You're a long-term trade at 150.47 with a stop at 149.07 and a take profit at 151.27. Okay, first of all, I don't think your ratio is good enough, because you're risking basically 1% to make, what is it, 0. Well, to make 0.5% really. That is not a great ratio. Secondly, you talk about a long-term trade. We've done 80 points overnight, and your take profit is 80 points above. That is not a long-term trade, in my opinion, unless your short-term trades are 15 minutes and your long-term trades are 2 hours, 3 hours to the numbers. I don't know what you're going to do over the numbers with it. I'm curious to know what you're going to do. But that's about what I have to say about this trade. Okay, if you would be in a long-term trade, not even talking about where your take profit also would be. If you are in a longer-term trade, I think your stop is sort of okay, because that's below the 61.8 of the prior high thing. but you could already think about putting it below 149.5, for instance, or 149.30. That is one thing. I understand you'll take profit, but well, I mean, mine would rather be, if I'm in a short-term trade, I would rather be just ahead of 151. If I'm in a longer-term trade, I would go closer to that prior intervention level. But if you're in a real long-term trade, then you just let it run. You may take a little bit off in this zone here, but then just let it run, you know. There's a trend line there which comes in just above 152. So that 152, if ever we get there, is going to be an important one, and that's for everybody. I just want to show you a long-term chart which I showed right at the beginning when we joined phase. This is what I showed there. This I even have to go back onto the weekly for that. There's this really long-term pattern, and it formed a triangle here. And I recall when I was just joining there, what I said, look at this dollar yen. It's about to break this very long-term triangle, and we could go up to 157 in dollar yen. So that's a real long-term trade, if you ask me. But of course, that's very difficult to defend. But yeah, you know, it's still a level that I keep in mind for those who watch really long-term stuff. It's ambiguous, Jamie, but if you really are a long-term trader, and really very few of us are long-term traders, a few of us in the retail sphere are. But first of all, if you're a long-term trader, you need to filter out a lot of noise, even a lot of data. You need to have a very firm idea of what's going on. But you must have deep pockets, because if you look at those moves that we had, even if you went in here, we still had this setback. Okay, I mean, reasonably speaking, and I was looking at this long-term thing when it traded up here. I said this is getting very, very dangerous, and we also had already the intervention. So even a long-term trader would have taken parts of the position off. But you need deep pockets with the rest of your position to keep it right. Okay, that just as an apartheid. Do you guys have any other? Ah, okay, Konstantin, see you then on Face. Yeah, so Jamie, I mean, I know you meant the GDP. Well, if it's strong, we should really start to trade above 5% again in the tens, and we probably will go back towards the highs here in the twos as well, right? So it should de facto underpin the dollar if it's strong GDP. And as I said, to me, anything if the market may short term already think that 4% is not enough because the 4.3 is expected, but I think anything 4 and above will create enough divergence with other major economies to keep the dollar pit in the more medium term. Okay. Now I want to quickly, before I leave you to it, show you a few euro crosses, because we have ECB. So we had this big setback on earlier in the week, and then the subsequent rebound. But look at what happened right into the ECB here. Okay, we had the Aussie selling off, with the euro staying stable, but now the Aussie, the rebound in the Aussie, I think, has been driven by this, and that's the market starting to manage their positions in euro crosses. These crosses, if you want to steer away from the dollar, I always say, like, keep an eye on what's happening on the cross side, and these crosses are going to be interesting post ECB. So depending on what ECB says, if I were you, I would keep an eye on 160, what's happening in the mid 166s, and especially in the low 166s on the euro Aussie, for instance. If you have Lagarde, who is surprisingly dovish, I think some of those euro crosses may start to suffer a bit. Okay, if in turn she keeps the hawkish side, I think this is going back to at least 168, 160. Yeah, we can tag back onto those higher levels. If you look at what's happened in the Euro Canada, it's exactly the same as well. This thing it was quite bullish, but now we are outside of the wedge. We can re-enter straight away if Lagarde is hawkish, and then we probably go and have a visit in the 146s. But what if Lagarde is a bit dovish? Then I reckon we can see levels back, these levels here, 144.50, for instance. That is if you want to trade crosses. We've seen a very, very big Euro Kiwi over the past sessions, and look, same thing happened this morning. We saw a setback because the people are managing their positions. If the ECB doesn't say anything special, those people are probably going to get back into their positions, okay? If she starts to be more dovish, then look at what's happening, for instance, in the Euro Kiwi around 180.80. If we get below, we can have a look back down to 180 the figure, and perhaps even below. But that's just some possibilities that I'm showing you. If you look at Euro Yen, for instance, well, that's a bit. Anyway, we are looking at that double top there in the Euro Yen at just close to 160, and we are trading 158.5. We are even trading a little bit below those prior highs. We are trading. We could argue that we are trading back in the box. If ECB goes dovish, this thing, why not, could trade back down to levels of 156.5, 157. Why not? If in turn she stays hawkish, it will probably, as it is a yen cross, probably go a bit slower, but it will likely see it back up there. It probably go a bit slower, I say, because there's always this overhang of what's happening with the MOF, right? And then Euro Sterling, yeah, this one well, a good few of us have been fooled by this move lower here, unfortunately, but that's the way the market goes. We are not divine. We are certainly only human. But it looks big indeed. So this one, if the ECB is still erring on the hawkish side, probably this 87.40 is going to be toast this time. The kicker will be just around 87.5. But if that would go, this trend line here, then we're probably talking about levels up into the 88s. And the underside, I think it's relatively straightforward, 87, and then the prior low. If it goes below, that means that ECB is starting to do a bit of 180. That means that they are recognizing the problems in growth and staying completely mum about any of the programs that they could start to tweak. That for the euro crosses. Gentle people, that is it for me for today. Stay safe. Trade also with a very, very good risk management, okay? If the market goes against you, don't be a hero. Don't overtrade. Don't start to move your stops and things like that. Always reassess, okay? Your answer to what, Ali? Just let me. The broker question. What broker question? Okay, can you ask it to me again, Ali? Okay, in retail trading, if we lose, who win the other trade? The broker take a position. Well, it depends on who the broker is, Ali. I mean, some use market liquidity providers, others keep it in their books, but there are pretty strict rules. You have to check with your own broker, yeah, to know whether they are keeping your positions in their books. I don't know. It depends from broker to broker, really. And that closes it for me for today. Okay, good luck, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.